All right, Matt Davio back with Greg Harmon. Greg, in our ongoing quest to figure out this game of trading, how you doing here on February 20th, or what is it, 21st, actually? 21st.
21st.
Lost a day there, 3-day weekend.
Yeah, 21st. Things are going well. Yeah, we've got the start of the next option cycle going on, so I've been doing a lot of options plays on earnings and options related to stocks to limit the downside risk as well.
Now, are you with a low vol environment? Are you buying options or are you selling?
It really depends. I haven't been doing many straddle or strangle plays, volatility type plays, but more so using technical analysis to determine XYZ stock. It looks like it's set up to move higher. It's got an earnings catalyst. How do I play for an upside earnings catalyst, but protect against the downside to also lower my cost?
So you're buying some puts on situations like that, and then some stock with it, kind of 1-to-1. Is there 2-to-1? Depends on the situation.
A lot of what I've been doing is call spreads or call spread risk reversals. So buying upside calls and selling downside puts to fund them.
Okay.
So a lot of leverage in it, but using the put levels on the downside under some severe technical levels.
So, the risk in that scenario and mostly long-sided plays here is pretty minimal because the insurance on the put side is pretty cheap. And, the stocks, as we all know here, never go down anymore. So, I mean, that's pretty good. It's a pretty good strategy in that regard until it isn't.
Until it isn't, yeah.
Yeah.
Yeah. So
how do you guard?
It's been working out pretty well.
How do you guard against that though? Until it isn't, because it's true. You pick up pennies in the corner and then you steamrolled at some point. But how do you kind of prevent that type of facility to happen? What kinds of things do you do to prevent that?
Sure. Well, first, as a reminder, the basis of what I do is first off finding the trend in the market. So I've spent a lot of time on the weekend looking for what direction the broad market's going to go and how things like gold, oil, bonds, et cetera, might influence that. Mm-hmm. So I'm essentially betting with the direction of the market. And then when I go to look at individual picks, with that assumption in place that the market is in a positive tone, and if I'm wrong on that part, then I'm going to be dead wrong on a lot.
Right.
But with the assumption that the market is favoring the upside, I'll then select to sell downside puts at levels where I'd be comfortable owning the stock.
So if the stock's trading at 45, you might be looking at 40 strikes, 42 strikes, 35, somewhere down in there. You'd love to get a 20% haircut down there.
Yeah, I'd say, this is going to air after we're done here today. So I'll tell you one that we're looking at today is Harmon. They report tonight after the bell. I think that the chart is favoring the upside, even though it's showing a real crappy looking candle for today.
Right.
But I'm selling 41 puts against it, 41 strike puts against it, because I think that's a pretty solid area, and I wouldn't mind owning the stock there.
So, things like, have you owned it for a while? Again, high of the year, 45.62. We just hit it. We just ran basically from 30 in the last 3 months up to, that number. Looks like every other chart that I see out there. Do you start to get a little nervous when some of the other indicators, like RSI, which has been overbought in this name probably since the stock was trading at around 35. So it's gotten, that's why a lot of those stochastics aren't really good technical trading tools, as I always like to tell people, and they're not. But you start to get a little nervous, going home in a position, or you know what your capped risk is on these positions.
Yeah, looking at Harmon, for example, the RSI has been over 70 for the most part all year,
right,
since the beginning of December. I wouldn't be buying the stock, and I don't own the stock.
Okay.
What I own is upside call spreads, right, that I bought today. I'm planning on selling them tomorrow.
Gotcha.
And I sold downside puts that I will either buy back if the stock moves very much so to the upside, or I'll just let them ride through to March expiration.
Right. So just so people understand, and we talk about this continuously, Greg, you got to define your time frame, what your risk is, and how long you're going to be in a trade like this. And you laid it out very nicely there. You're looking at March options, both on the put and the call side, and you're basically betting that, listen, this thing's strong, the technicals are good, and there's no reason for earnings not to be good. All companies are pretty much, hitting their numbers right now, so that makes a lot of sense. But on the downside, you're willing to bet that it's probably not going to go below 35, 36.
Yeah, even I'm even comfortable owning it at 41 here if it stops that far.
Okay.
But there's a little more to it than that. I do a bit of research on the company as well and see how it's moved historically based on its prior reports.
Right.
And certainly look at the volatility built into the options to see where the options are pricing it to move by March expiration.
So with retail, doing so strong, tech doing strong, gas, oil exploration, oil's trading at new highs today again, 106.30. It's been as high as about 106.50, 70, somewhere in there. Earnings are strong. How long can we be overbought, and how long can we continue to go up in this market? It's a loaded question. I don't have the answer.
Yeah, I mean, back in December, day before year end, I wrote a piece on the SPY where I pointed out that my long-term charts, looking at things like the Andrews Pitchfork tools, the point and figure charts, as well as Fibonacci's and others, combining a whole mosaic of all those, I see that the SPY could get up to 161.
Right.
I don't think it's going to go straight there, although it kind of looks like it wants to.
It really could. I mean, so which parlays into about a 1,600 number on the S&P, possibly at some point this year. Hey, why not? I mean, it's, the one thing that's interesting though, and we had so many days last year where we had, 1% to 2% sell-offs or 1% to 2% gaps. We don't have real big upside days, and although we definitely don't have downside days, we don't have real big upside days either. Any thoughts on that? I've kind of said to traders that are like you and I that have done this game for 20 years, it's like technicals don't matter a lot right now. There aren't a lot of pullbacks to buy. They're very thin. So things like that you're talking about is, again, earnings situations, special situations. Fundamentals to me never matter a heck of a lot. So, what are you relying on? Is it gut more than ever on a lot of your trading right now?
No, it's not. But it's longer term charts. It's more reliance on weekly charts than on daily charts.
Okay.
Daily charts are useful to me now for these very short-term overnight plays. But if I'm going to go look at something like Apache Corp, which we did last week, I'm going to look and be certain that the longer-term charts are pointing that the direction is higher as well.
Right. So again, looking at starting from the longest term out type of trend, and then work backward from there and finding attractive plays within the smaller term setups that fit into those parameters makes a lot of sense to me.
Yeah.
Oil. What are your thoughts there? I mean, are we going to go back to this 150? We were kind of hanging around this 90 to 105 for a long time, and we're running again.
Yeah, I've had that 93 to 103 range for a long time, and we're definitely breaking out of that now. Next upside I see is 115. The levels from, when was that? Back in the middle of 2011, April 2011.
Right.
About that time frame, 113.50, somewhere in that range.
Yeah, so that's $6-7 away from here, not too far. But again, we're it's amazing. I've never seen a time, I don't think, where volume has been so light. A lot of the days in the past couple of weeks have been 10-year lows. Does that affect the way you look at things, Greg? Is volume important still?
Well, volume has always been a secondary indicator to me. I know that a lot of students of technical analysis will say that you need volume to confirm every move, but you can't buy and sell volume. You don't get paid on the volume. You get paid on the price movement. So with all of the high frequency trading going on that's influencing how much actual volume there is, I've put a lot less faith in that and stuck more to the price action and looked to things like volume, RSI, MACD, and other volatility measures to confirm what the price action is saying.
Right.
So it's important. If it's materially different, it becomes more important to me.
So again, using all the tools in your tool belt becomes more important. It's not one indicator over the other. It's not, price being still the ultimate arbitrage is most important. Mm-hmm. What other kind of things are you looking at macro-wise now? I'm tired. We've got Greece, we've got the pigs, we've got every country's bankrupt, including this fine country. But yet stocks are going to continue to go up. It's an election year. Nothing's going to get changed and done politically. You're pretty secure there unless there's a war. Nothing's going to happen really probably for the next 9 to 10 months.
Yeah, it seems to me like the big factor that has been weighing on the market, but has continued to confound everyone is the next direction, not the next direction on bonds, but when it's going to change. Mm-hmm. Yeah, bonds have been, we've talked before, I look at the TLT instead of the futures on the bonds, sure. And the TLT's been moving sideways for 5 months now.
Yeah.
It's just, it's